Well guys, it looks like the stock market has finally bottomed in the short term. To the surprise of most retail investors and a lot of hedge funds, the market is not performing as poorly as many people expected in March. The QQQ is almost up 15 to 17% from its low it made on March 14th, which is right before the March 16th Fed meeting. But despite the insane strength I've seen in the stock market recently, there is still a lot of fear around a recession happening and runaway inflation in 2022, which is somewhat getting dismissed by the latest PCE data that came out this morning. So in this video, I'm going to give you guys a breakdown on the latest inflation data, give you guys an expectation of what could happen if we go into recession, and also analyze why exactly I think we're not going to go into as severe of a recession as many people are expecting. But before we get into it guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So the first thing we want to address is the PCE inflation data, which came out at around 6.4% earlier today, and this is a very important indicator of how the Fed might raise rates over the next year. You see, the PCE stands for the Personal Consumption Expenditure Index, and this is essentially the CPI index or the Consumer Price Index minus the fluctuations of price in oil and food. And the simple reason for that is because those commodities are often very volatile, and so if the Fed is going to make a decision based on current inflation data, they're going to mostly focus on the PCE instead of the CPI. And as you can see, the best part is that this data came in right in line with analyst expectations of around 6.4% year over year and around 60 basis points month over month. And the reason why this is a good thing is because the main fear that a lot of stock market investors have been pricing in is the fact that inflation might be runaway and the Fed might need to be more aggressive with raising interest rates, potentially putting us into a recession. And so if the PCE, which is the most critical indicator the Fed looks at, is coming right in line with analyst expectations, then this is a good sign for the market and a potential relaxation for investors who might be panicking over the past 6 months. And what many people don't understand is that after a recession like we saw in March of 2020, the market will always have a significant amount of pent-up demand. And that's obviously because consumers delay their purchases of non-durable and durable goods all the way to after the recession is over. And so what that means is that the stocks that are able to match supply and demand properly and tackle inflation through pricing power are the ones that are going to end up performing very well. And that's why I believe in the next 12 to 24 months, this is going to be a stock picker's market and not necessarily an index investor's market. And as long as we have a strong runaway for growth over the next 2 years, which is something we're seeing from a lot of earnings calls and guidances over the past 2 months, then we won't necessarily see a multiple compression in tech stocks during a rising rate environment. And that's a big reason why stocks tend to do well in moderate inflation times, because big tech stocks have a lot of pricing power to fight inflation. And as we've clearly seen over the past 2 months, the demand destruction we're seeing in oil, used car prices, and retail sales can certainly help us avoid a rapid inflation environment. And so as long as we don't go into a runaway inflation phase, which is something we're not seeing right now as seen through the PCE data, then stocks should do relatively well. And by far the most surprising thing that is also a bullish indicator for stocks is the fact that fund managers are sitting on record levels of cash that we haven't seen since March of 2020. Now, many folks might count this as a sign of a recession actually coming this year because of just how scared institutional investors are. But the reality is that whenever the FMS index has peaked to very high levels, the market has always rallied over the next 24 to 36 months. And the simple reason for that is because these fund managers often raise cash at the worst possible times right before everything gets priced in. And on top of that, what many people are not realizing is that even though the Fed is still raising rates slightly this year, the real interest rate that consumers are actually going to be affected by, which is the nominal interest rate minus inflation, is still extremely low. You see, the Fed funds rate is sitting at around 25 basis points right now, and the PCE inflation index is sitting at around 6.4. So if you subtract the two numbers, you get a real interest rate of around negative 6.4, or in this case, negative 5.4% as of November 2021. And as we all know, one of the reasons why the stock market rallied so aggressively throughout 2020 and 2021 was the fact that interest rates were very low and the cost of borrowing was very easy. So people went out and bought a lot of assets, and that in turn caused inflation. And what this means is that the demand for assets like stocks and real estate is still going to be relatively high going forward. Because at the end of the day, you're not going to get any return or yield by buying bonds or treasuries right now. And that same argument that was brought up in 2020 can be brought up in 2022 as well, and we all know how the market reacted in 2020. Now, if we move on to addressing the big elephant in the room, which is something that many people have been talking about, which is the yield curve inverting earlier this week. I think that this is not as big of a deal in the short term as many people have been making it out, because the actual pairing of yields that inverted for a significant amount of time was the 5-year and 30-year. And this happened for the first time since 2006, which, unlike what CNBC might be thinking here, is not a bad thing. Because obviously we had a market crash in 2018, 2016, and obviously in 2020, and this yield curve did not invert for any one of those. And as you can see, the actual yield curve pairing you want to focus on is the 2-year and the 10-year, because that one is the one that has accurately predicted recessions for the past 20 years. And as you can see, as of the recording of this video, this yield curve is sitting at around 11 basis points, meaning that it has not fully inverted just yet. And unless we break below the 0% level and hold below it for a significant amount of time, like multiple weeks or multiple months, this indicator might not be as reliable in the short term. But obviously, if there are any macroeconomic events like the Russia invasion lasting longer than expected or inflation starting to go into a runaway situation, then yes, this curve will definitely invert, and that could signal we could go into a GDP contraction in 2023. But the good sign is that even if we somehow go into a paper recession in the next 12 months or so, the market for labor is so strong right now that we might not see a very strong lasting impact to the economy. As you can see, consumer confidence is still up relatively high since February, which means that generally speaking, people are still going to go out there and spend money, and that's going to help prop up earnings and revenue for stocks. And as you can see, finding a job in America these days is not that hard, and unless this turns into a wage price spiral situation, then this is not at all a bad thing going into a recession. This strength in the labor market will certainly soften the blow of any recession we might face, and it will certainly strengthen the recovery we'll see from such a contraction. If we now have a look at the stock market, as you guys can see, the index that I personally like to follow for my growth stocks, which is the IWM index, has finally broken out of this very key resistance level at around 206. Now we are coming down to retest that, so we have to see if this breakout actually holds, but generally speaking this is very bullish because we have actually broken out of this insane bear market we've seen since November. And for the first time since November, we're also back above that 50-day moving average. And so for us in the short term, growth stocks are definitely looking very strong. And to be honest, this should not come as any surprise because I've been hammering the table over the past few weeks about buying the dip aggressively because of the insane fear we were seeing in the market. And this pullback was simply not needed, and it was just an anticipatory sell-off going into the Fed meeting. This is evidently visible to the Fear and Greed Index, which was sitting at around 24 just a month ago. That means that this needle was deep in the red somewhere around here, and just in a matter of 2 weeks, this needle is now in a neutral zone. So in the short term, yes, the market is probably going to pull back to maybe 2 to 5%, but overall, the market is still very bullish for 2022, at least for small caps. We don't know if the S&P 500 is just going to go sideways, and unless some macroeconomic situations develop or the Fed comes out with a 50 basis point hike, then stocks should do relatively well in 2022, and I would definitely take advantage of a lot of the small cap and growth stock deals we're seeing today. And as you can see, the list on the left right here is my primary long-term portfolio going into April 2022, which includes a lot of small cap growth stocks in the clean energy and software space. And I also have some incredibly good value buys like Facebook and Alibaba as well. And so for me, if we see any negative pressure in the market over the next few weeks, I will continue to buy the dip and build the positions in some of my favorite companies. But anyways guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below your guys' thoughts on the PCE inflation data that came out and the rebound we have seen in the stock market. But anyways guys, I hope you enjoyed this video, and I'll catch you guys in the next one. Take care.